For 50 years, the world had a deal. Oil gets priced in dollars, dollars get recycled into US Treasuries, America gets to borrow cheaply, and your savings benefit from a strong dominant currency. That deal is cracking, and last week it cracked a little bit more. Take a breath. In the next 12 minutes, I'm going to show you exactly what's happening to the dollar's role in the world, why it matters specifically to your retirement savings, and the three things I'd be thinking about right now. Do you feel like every time you turn on the news, you hear that the dollar is either totally fine or completely collapsing, and you have no idea which one to believe? I'm KK, a simple, regular investor who has worked hard over the years to build a portfolio, and I've seen the ups and downs of markets firsthand. I'm not a fund manager. I'm not on Wall Street. I'm someone who made mistakes, learned from them, and kept going. This is not financial advice, and you should talk to a professional before making any investment decisions. Now, let's talk about what's really happening to the US dollar. Let me take you back to 1974. The US had just come off the gold standard 3 years earlier. Nixon had closed the gold window in 1971, meaning the dollar was no longer backed by anything physical. That created a real problem. Why would the rest of the world keep using dollars if they weren't backed by gold? The answer came through a deal with the world's biggest oil producers. The arrangement was this: oil, the world's most essential commodity, would be priced and settled exclusively in US dollars. In exchange, the US provided security guarantees and economic partnerships. And here's why that arrangement was so powerful for America. If every country in the world needs dollars to buy oil, and every country in the world needs oil, then every country in the world needs dollars. That creates a permanent structural demand for the US dollar. It allowed America to run deficits, borrow cheaply, and essentially export its inflation. The dollar wasn't just a currency. It was the operating system of the global economy. For 50 years, that system held, and for 50 years, it quietly subsidized your cost of living, your mortgage rates, and the stability of your savings. Now, here's where it gets interesting. And this is the story I don't think enough people are telling clearly. That system is fracturing. Not collapsing overnight, but fracturing. And the pace is accelerating. Just last week on May 1st, 2026, the United Arab Emirates formally exited OPEC after nearly 6 decades of membership. Let that sink in. The UAE is one of the most significant oil producers in the world, and it has left a cartel that has anchored the petrodollar system since 1974. Now, the UAE didn't leave OPEC to start a currency revolution. They left because of their production ambitions. They want to pump far more oil than OPEC's quota system. But here's what matters for us. The consequence is the same whether the intent was there or not. When a major Gulf producer steps outside the institutional architecture that kept oil priced in dollars, you've opened a door. And doors once opened don't always close. The UAE had already been floating the possibility of pricing some oil transactions in alternative currencies if dollar liquidity tightened. They joined BRICS in early 2024, gaining access to expanded yuan, rupee, and ruble settlement frameworks. And they're a founding partner in something called MemBridge, a multi-central bank digital currency platform that enables real-time cross-border settlements outside the SWIFT system. These aren't theoretical experiments, they are functioning infrastructure. Here's the honest assessment, and I want to be balanced here because I think intellectual honesty matters more than a dramatic headline. The dollar is not collapsing, at least not yet. Percent of global oil trade still settles in US dollars. The dollar still has no serious rival as the dominant reserve currency. And this is the key number: roughly 20% of global oil transactions now settle outside the dollar system. That's up from essentially 0 2 decades ago. And that share is growing. The direction of travel matters more than today's snapshot. Here's a data point I find genuinely striking, and it's one that takes 5 seconds to understand once you hear it. In 2001, the US dollar made up 72% of all global foreign exchange reserves. That means when central banks around the world held their savings, their national reserves, nearly 3/4 of it was in US dollars. Today, according to IMF data through Q3 2025, that figure is 56.9%, down from 72% to 57% in 25 years. Now, 57% still sounds dominant, and it is. No other currency comes close. The euro is at 20%, the yuan is at just under 2%. But here's what the trend tells you. The world's central banks, the entities responsible for protecting their nation's savings and financial stability, have been quietly, systematically reducing their exposure to the dollar. Not because they hate America, but because they're diversifying risk. Just like you should be doing with your retirement savings. And here's what they're moving toward: gold. According to the Federal Reserve's own research, the share of gold in official reserve assets has more than doubled, from below 10% in 2015 to over 23% now. Central banks bought 863 tons of gold in 2025, and that was after 3 consecutive years above 1,000 tons. The World Gold Council data shows that 95% of central banks surveyed expected global gold reserves to increase in the year ahead. Some estimates put 2025 central bank buying, including unreported purchases, at over 1,200 tons. Let me put that in plain English. The people whose entire job is to protect national wealth are reducing their dollar exposure and loading up on gold. That is not a coincidence. That is a signal. Now here's where these two stories, the petrodollar erosion and the dollar reserve decline, connect to something that hits even closer to home. The petrodollar system wasn't just about oil pricing. It was about what happened to those oil revenues after they were earned. Gulf producers would earn dollars selling oil, then recycle those dollars back into US Treasury securities. This recycling of petrodollars kept demand for US debt artificially high, which kept interest rates lower than they should have been. If that recycling slows, and it is slowing, the US has to find other buyers for its debt. And that debt burden is not small. As of right now, the US national debt is approaching $39 trillion, the third highest in American history. Fortune reported this week that the US Treasury will borrow more than $166 billion every single month this year just to keep the lights on. And interest payments on that debt already approaching $900 billion a year. I want to be careful not to use a number I can't stand behind here. But the CBO data is clear. Deficits are projected to average more than 6% of GDP over the next decade. For context, the 50-year average is 3.8%. We are running structural deficits that are nearly double the historical norm in a period of relative peace and reasonable economic growth. The numbers don't improve from here. Here's the so what for investors. When the petrodollar recycling loop was strong, America could borrow cheaply and run deficits without immediately paying the price in inflation or higher rates. As that recycling weakens, as fewer oil dollars automatically flow back into treasuries, the US has to offer higher rates to attract buyers. Higher rates mean higher inflation risk. Higher inflation risk means your purchasing power, the real value of your retirement savings, erodes faster. This is not a 2030 problem. It's a process happening right now, gradually below the headlines. The DXY, the US dollar index, which measures the dollar against a basket of major currencies, is sitting around 97.9 this week. That's a 12-month low range. Gold is trading at approximately $4,750 per ounce as of this morning, up over 41% year on year. Silver is at $80 per ounce, up over 147% in the past 12 months. Gold overtook US Treasuries in late 2025 to become the world's largest reserve asset by value. Read that sentence again. For the first time in modern history, gold, not US government bonds, is the single biggest reserve asset in the world. The charts are telling us something specific right now. Gold has a structural demand floor around $4,500 to $4,600, where central bank buying becomes aggressive. The longer-term institutional forecasts from major financial institutions are pointing toward $5,000, $6,000 as a 12-month range, driven by continued central bank accumulation and the fiscal backdrop. When the fundamentals and the technical picture are both pointing in the same direction, you pay attention to that. You don't panic. You think, all right, here's where I want to be practical. Because knowing the macro story is one thing. Knowing what to do with it is another. Number one, understand the distinction between owning dollars and being exposed to the dollar. Most retirement portfolios are overwhelmingly dollar denominated. Your super or 401k holds stocks and bonds priced in dollars. Your cash savings are in dollars. That's not wrong, but it means your portfolio has almost no hedge against dollar purchasing power erosion. The question to ask yourself is, if the dollar weakens by 15-20% over the next decade relative to real assets, what does my portfolio look like? Physical gold and silver are one answer. Gold-backed ETFs are another, more accessible starting point. Number two, don't mistake short-term dollar strength for long-term dollar dominance. I get it. I've fallen into this trap myself. When the dollar gets a brief bounce, safe haven demand, a hot CPI print, geopolitical jitters, it's easy to think the de-dollarization story is overblown. It's not. Structural shifts are slow. They don't announce themselves loudly. They happen in the background, quarter by quarter, reserve report by reserve report. The 72% to 57% move in reserve share took 25 years. The next 10 percentage point move won't necessarily take another 25. Number three, think about a 5-10% allocation to physical precious metals as portfolio insurance, not as a trade. This is the one I've had to remind myself of repeatedly. Gold and silver in a retirement portfolio aren't about making a killing in the next 6 months. They're about structural insurance against the scenario where dollar-denominated assets underperform for an extended period. If you have $500,000 in retirement savings and you hold 7% in gold and silver, that's $35,000 providing you a hedge against the exact scenario this video is describing. Look into physical gold coins and bars through reputable dealers. Consider allocated gold storage if you want institutional grade custody. And always check premiums. In 2026, physical gold premiums have remained elevated due to high demand and supply constraints. So what's the conclusion? Gold is near $4,750. Silver is at $80. The US dollar reserve share is at a 25-year low. The UAE has walked out of OPEC. Central banks bought 863 tons of gold last year, and the consensus is they're not stopping. None of this has changed the fundamental reality that the US dollar is still the world's dominant reserve currency. It still is. But for the first time in 50 years, the structural machinery that kept it dominant, the petrodollar recycling loop, the automatic demand for treasuries, the compulsory need for dollars to buy energy, that machinery is being rewired, slowly, structurally, in the background. The real question for you isn't whether the dollar will collapse. It won't. Not quickly, not cleanly. The real question is, if the dollar's purchasing power erodes by 2% more per year than it has historically, what does that do to your retirement over the next 15 years? And does your portfolio have any protection against that scenario? That's what I'd be thinking about this week. If this video helped you, please subscribe. I put out one of these every week, always grounded in real data, always aimed at the questions that actually matter for people like us. And drop a comment below. What's your current gold allocation, if any? 0, 5%? More, drop it in the comments. I read them all. See you next week.